You've been doing everything right. You earn over $150,000. You max out your 401k, and every year you make your catch-up contributions. Because every financial advisor in this country will tell you that for high earners in their 50s, this is the single most powerful legal tax shelter available. Pre-tax contributions, lower taxable income, the government waits, you win. That's the deal. Except as of January 1st, 2026, that deal has been permanently revoked, and most high earners have no idea. Here's the part that should actually make you angry. This wasn't a glitch in the system. Congress did this deliberately. They buried it inside a law called the Secure 2.0 Act, the same law they sold to the public as the most pro-retirement legislation in a decade. We're going to show you exactly what they actually built, and we'll answer the question that nobody in mainstream finance wants to say out loud. Why did Congress specifically exempt business owners making millions while targeting W-2 employees earning $151,000? Keep that question in mind. We'll come back to it. Let's set the scene. You're 54 years old. You've spent 3 years aggressively maximizing retirement contributions because someone finally told you about catch-up contributions, the IRS provision that lets workers over 50 save beyond the standard annual limit. In 2026, the regular 401k limit is $24,500. The catch-up on top of that is $8,000. If you're between ages 60 and 63, there's an even bigger version, $11,250, called the super catch-up. For someone in the 32% federal bracket, maximizing that $8,000 catch-up saves $2,560 in taxes every single year. That's not a minor line item. For high earners, that's one of the last remaining levers that still works. Or it was. Starting this year, if you earn more than $150,000 from your employer in 2025 and you're 50 or older, you are legally prohibited from making that catch-up contribution on a pre-tax basis. The IRS now forces every dollar of your catch-up into a Roth account, after tax, up front. Their timeline, not yours. And here's where the trap gets technical, because there's a version of this that's even worse than losing the deduction. We'll get there. But first, you need to understand what this law actually is, and who it was actually built to punish. The Secure 2.0 Act was signed into law in December of 2022. The headlines called it historic. Bigger catch-up limits, more flexibility, new provisions for workers who hadn't saved enough. That's all real. But buried inside Section 603 of that same legislation was a provision that Congress never led with in the press release. A provision that the Joint Committee on Taxation scored as a net revenue raiser in the first 10 years. Here's what that means in plain language. When you put money into a traditional pre-tax 401k, the government agrees to wait. They defer the tax until you retire, potentially 20 or 30 years from now. That future collection is a liability on the federal ledger. It doesn't help the budget today. But when you put money into a Roth account, the government collects immediately, at your highest current marginal rate, right now. So the question you have to ask is simple. If Congress wanted to help high earners save more for retirement, why did they simultaneously strip away the most valuable feature of doing so? The answer is because Section 603 was never about your retirement. It was about front-loading federal tax collections inside a 10-year budget window. Congress took the retirement savings behavior of high-earning W-2 employees, disciplined, predictable, compliant behavior, and converted it into a revenue stream that solves a near-term deficit problem. Your retirement account is being used as a short-term liquidity facility for the federal government. And there's one more layer to this. High earners in high-tax states have used a specific strategy for decades. Defer income into pre-tax accounts while paying peak state tax rates. Let the money compound untouched. Retire to Florida or Texas. Withdraw at zero state income tax. The forced Roth mandate obliterates this entirely. A 61-year-old executive in California maxing out the super catch-up of $11,250. Before 2026, that contribution deferred a 13.3% state tax. Under the new mandate, California takes $1,496 immediately, every year. Gone. Permanently removed from the portfolio before it ever has a chance to compound. The government didn't just change how you contribute. They outlawed your ability to time your state tax liability. Now, remember that open loop from the beginning? Why W-2 employees and not business owners? We're getting there. But first, there's a trap inside the trap. This is the part most financial content skips. And it's the part that will actually determine whether you've already walked into the trap without knowing it. The $150,000 threshold that triggers the Roth mandate is not based on your adjusted gross income. It's not based on box 1 of your W-2, your taxable wages, the number you've been paying attention to. It's based on box 3, Social Security wages, FICA wages, the number almost nobody looks at. Here's why this matters. Take a professional earning $165,000. They've been aggressive. They contribute $20,000 to their traditional 401k pre-tax. Their box 1 drops to $145,000. They feel safe. Their box 3 stays at $165,000. Because standard pre-tax 401k contributions reduce your taxable income, but they do not reduce your FICA wages. The IRS chose box 3 specifically because it's nearly impossible for a W-2 employee to manipulate. The only deductions that actually reduce box 3 are Section 125 cafeteria plan elections, pre-tax health insurance premiums, FSA contributions, and dependent care accounts. If you're hovering close to the line, say projected at $153,000, that is your only legal lever to push your FICA wages below the threshold before the look-back year closes. Now, the lockout. Here's what happens if your employer's 401k plan doesn't currently offer a Roth option. Under the final IRS regulations, if a plan has no Roth feature, your catch-up contribution limit as a high earner is not $8,000, it's $0. You are entirely locked out of the extra retirement savings space. Not because you did anything wrong, because your HR department is behind on paperwork. Every employer sponsoring a 401k plan must formally amend their plan documents to include Roth provisions by December 31st, 2026. If they missed that deadline, if the payroll system wasn't reconfigured, if the record keeper wasn't updated, high earners in that plan get zero catch-up access. ERISA attorneys are calling this the #1 compliance risk of 2026. Payroll systems that were never updated are processing contributions incorrectly right now. Some high earners' elections are already routing as pre-tax when they're legally required to be Roth. If that gets corrected after the W-2 is issued, the employee owes immediate income tax on the reclassified amount, and all associated market earnings get forced into the Roth as well. The system set a trap. Then it handed your employer a second trap inside the first one. Now, let's close the loop we opened at the beginning. Go back to the question. Why does the Roth mandate specifically target W-2 employees, while leaving an entire class of earners completely untouched? The answer is in the legal definition of who the mandate actually applies to. Section 603 of Secure 2.0 only triggers if you receive FICA wages from the employer sponsoring the plan. Partners at law firms, accounting firms, medical practices, they receive K-1 income, not FICA wages. Sole proprietors, self-employed individuals, business owners drawing distributions, none of them are subject to the Roth catch-up mandate. A self-employed business owner generating $5 million a year in net profit can continue making pre-tax catch-up contributions to their solo 401k, completely untouched, full tax deferral, full geographic arbitrage, full control. Meanwhile, a W-2 middle manager earning $151,000, who has less wealth, less flexibility, and fewer options, is forced to pay taxes up front. And there's one more detail that reveals exactly how arbitrary this legislation actually is. If you work 2 jobs, say a primary hospital at $100,000 and an independent clinic at $125,000, your aggregate income is $225,000. But because neither individual W-2 box 3 exceeds $150,000, you are completely exempt from the mandate. $225,000. Exempt. $151,000. Forced Roth. The conclusion is unavoidable. The Secure 2.0 Roth catch-up mandate is not a retirement enhancement designed to help you save more. It is a revenue mechanism engineered to harvest liquidity from the most captive, predictable population in the tax code. Highly compensated W-2 professionals who follow the rules. Being a high-earning employee doesn't make you privileged in the eyes of the IRS. It makes you a target. So what do you actually do about it? There are 4 moves available right now. Not all of them apply to every situation, but between them, they cover almost every scenario a W-2 high earner faces in 2026. Move 1. The Box 3 Audit. Pull your 2025 W-2 right now. Look at Box 3, not Box 1. Box 3. If that number is above $150,000, the Roth mandate applies to you in 2026. If you're close to the line, projected between 150 and 160,000, your window is open enrollment. Aggressively maximize pre-tax medical premiums, HSA funding, FSA accounts, and dependent care contributions. These are the only deductions that suppress Box 3 FICA wages. Used correctly, they may push you below the threshold and preserve your pre-tax catch-up access. If you're well above 200,000, 250,000, don't waste energy on this. Your focus shifts to the other three moves. Move 2. Audit your employer's plan immediately. Contact HR or your plan administrator this week. Ask one specific question. Has the plan been formally amended to include Roth contribution features, and is payroll configured to route high earner catch-ups correctly? If the answer is no or unclear, you are at risk of the $0 lockout. Push hard. The employer amendment deadline is December 31st, 2026. That window still exists, but it won't exist forever. Move 3. The mega backdoor Roth. Here's the mindset shift that matters most if you're above the threshold and you can't escape it. If the government is forcing you to make after-tax contributions anyway, stop playing small. The total annual addition limit under IRC Section 415C is $72,000 in 2026. That's the ceiling for all contributions combined: employee, employer, and after-tax. If your employer's plan permits two specific features, after-tax non-Roth contributions and in-service withdrawals, you can funnel up to $46,500 of after-tax money into the 401k beyond the standard limit and immediately convert it to a Roth IRA or in-plan Roth account. That's not $8,000 of forced after-tax contributions. That's potentially $46,000 growing completely tax-free. The government handed you a mandate. This strategy turns that mandate into a vehicle. Not every plan allows it. Confirm with your administrator. But for plans that do, this is the most powerful response available to a high earner in 2026. Move 4. Structural independence. The K-1 exemption isn't just a loophole to be angry about. It's a roadmap. If you have a marketable skill, consulting, advisory work, board service, freelance expertise, establishing an independent income stream outside your W-2 creates a separate pool of self-employment income. That income can fund a solo 401k, and that solo 401k is not subject to Section 603. You're not hiding from the mandate, you're building outside its jurisdiction. The mandate applies to FICA wages. Income from a separate entity you own and operate is not a FICA wage. That is the exact same structural principle that exempts the $5 million business owner. It is available to you. Let's close everything. December 2022. Secure 2.0 Act signed. Section 603 quietly embedded inside. August 2023. The IRS issues emergency relief, delaying implementation from 2024 to 2026 because more than 225 major employers signed a letter saying their payroll systems couldn't handle it. Read that again. The institutions that run retirement plans weren't ready. They needed 2 extra years. September 2025. Final regulations published. No further delays. No extensions. The trap is operational. January 1st, 2026. Section 603 goes live. The surface problem is clear. Your pre-tax catch-up deduction is gone. The deeper problem is what it represents. The default path: trust HR, follow standard advice, max the pre-tax 401k, wait, was designed for a system that has been structurally altered to harvest your compliance. The government does not need to force a business owner to prepay taxes. The business owner has flexibility, timing control, and structural separation that W-2 employees were never given. The trap was always designed for you specifically, and the response is not outrage. Outrage doesn't change your Box 3 number. The response is clarity. Here's the action that matters right now. Pull your 2025 W-2. Look at Box 3, not Box 1, Box 3. If that number is above 150,000, your catch-up is Roth in 2026. Non-negotiable. The trap has already sprung. Now you decide what to do with that information. Do you audit your employer's plan for the Roth amendment? Do you go back to HR with a specific question they may not be prepared to answer? Do you model the mega backdoor Roth to see if your plan allows it? Do you open that consulting LLC you've been putting off? Every one of those is a move, and every one of them is available to you. The people who will lose the most to this law are the ones who continue doing exactly what they've been doing, because nobody told them the rules changed. You were told to trust the default path. The default path was redesigned to serve someone else's budget. Now you know.